and welcome to the Synctera Prepare for Liftoff webinar. Everyone here at Synctera is truly excited to get this opportunity to speak to a number of our existing bank partners, as well as several prospective partners who are joining us today as well. My name is Mike Morel, and I'm a bank sales executive and relationship manager here at Synctera, and I will be the moderator for the webinar today. After a brief overview of the webinar and speakers, I'll provide some background to my experience prior to joining Synctera. Next, I would like to introduce our panelists for today. First is Shep Smith, Synctera's Chief Operating Officer, and who will be our speaker in presenting the webinar in just a moment, as well as Chet Montefering, who is the Chief of Staff to the CEO. One quick thank you to our marketing team here at Synctera, who helped bring this webinar together and assisted with the presentation. As we referenced in our invitation last week, the purpose of this webinar is to present a more detailed and concise overview of the Liftoff program, as well as provide some context to the contracting and matching process. As there are several bank partners on the webinar today who are already on the Liftoff program, some of this information should reiterate and mirror the process that you are currently participating in, as well as provide some background for some of the recent changes and align for a seamless collaboration in the future. A few administrative items before we begin our presentation. If you do have a question during the webinar on a specific slide or topic, please feel free to ask the question during the presentation, and we'll do our best to answer or address that immediately. We will be recording the webinar today, and we do ask that you simply write the question without a person's name or bank name to allow for anonymity in the Q&A tab. Once the presentation is complete, we plan on allowing for another 10 to 15 minutes of Q&A at the end, which could be around today's topic or any other questions that you would like addressed about Synctera. So let's begin. As I stated initially, my name is Mike Morel, and I'm a bank sales executive and relationship manager, and I joined Synctera in the fall of 2021. My background and experience probably mirrors many of the individuals on the call today, as I have 20 plus years in commercial banking, specifically commercial lending and treasury. I've worked for a number of community banks ranging in asset size of 200 million to an excess of 10 billion. I'm located just outside Philadelphia. However, the majority of my career has been in the New England area, where I was also Senior Vice President, Head of Business and Consumer Banking for a $5 billion community bank in Greater Boston. I was drawn to Synctera plain and simply because the model and infrastructure that our founders created is second to none. As a lifelong banker who understands that banking is predicated on managing risk while also driving revenue, Synctera stood out to me that they realized early on that in order to be successful in the fintech banking space, you need to balance both of those things. And the success that the company has seen year over year, month over month is a testament to that. So that's a little bit about me. And so without further ado, let's turn it over to today's speaker, Synctera's COO, Shep Smith. Shep, the floor is yours.
Thanks very much, Mike, for the intro, and welcome to all of our guests. Thank you for taking the time to join us today. So let me pull up my screen here. All right, Mike, can you see my screen? You can, perfect. You can?
Yes.
Yes, great. All right, good morning, everyone. Thanks again, Mike, for the intro. Just really quickly, before I jump into the slides, I'll say just a bit more about myself. Again, Shep Smith, I'm the COO here at Synctera and have been with the company for a little over a year. It's been a super fun time so far, and we'll talk through a little bit today of some of the ground we've covered and what we're up to and how the company and our approach to fintech banking has evolved over the last year or so. And just prior to joining Synctera, I spent the last 10 years at Google in a variety of roles, most recently as a director in the payments group. But before that, spent a bunch of time working on device ecosystem stuff and operating systems. So Android, Chrome, Chrome OS, et cetera. And before that, spent the early part of my career working with financial service institutions as a consultant. So excited to talk to you all today. And before diving into the meat of the presentation, just wanted to give a quick recap of where we are today as Synctera. I think everyone on the call is sort of pretty well familiar with our model and what we're doing, but just the sort of really quick recap is we are looking to build and believe we have built a platform that makes it as fast and easy as possible for any fintech developer to build banking products into their app. And then on the banking side of our platform, we're striving to make it as easy and fast as possible for banks to get into banking as a service or fintech banking and remove a lot of the barriers and costs that have traditionally been associated with getting into that business. And we made a lot of progress. So the company was founded in 2020, spent the first year or so of our existence really building out our platform, and have been going to market in a very serious way over the last year or so, and have made a lot of really good progress. So on the banking side of our platform, today we have 11 bank partners, all of whom we've signed up in the past year, which is really exciting. And we're now starting to drive a lot of great traction on the fintech side as well. So just in the first part of this year, we've signed 16 fintechs. We're sort of operating at about a fintech a week is the clip we're going at. But the exciting thing is that's really accelerating. We'd only signed sort of one fintech to the platform last year and have been accelerating rapidly through the first quarter of this year. And as of today, we've got over 20 fintechs actively contracting to join the platform, and another 100 or so in various stages of our funnel. So it's been really exciting to see our value proposition resonating both with our bank partners as well as our fintech customers, which has been really great. A few other highlights from the first part of this year. We now have our first 4 fintechs live in production on the platform, which is really exciting, and several more, I think 3 or 4 more going live just this month. So as you can imagine, it's a reasonably long sales cycle. We go and work with fintechs through the onboarding and compliance processes, and then they do their build and certification and launch into the market, which can take some time. But the exciting thing for us now is we have a bunch of fintechs that are getting to the end of that journey and starting to go live and drive usage on the platform, which is really exciting. We've also extended the types of use cases that we can support. We've added a few new banks to our roster who have support for use cases like crypto and cannabis, which are really interesting and rapidly growing segments of the fintech landscape, which we can now support. So that's been really fun to see. And then finally, another fun highlight from Q1 is we launched a developer environment, which we call T-10. And the really cool thing about this is it allows any developer to come in, create an account, and start building and actually prototype an end-to-end product with real money that they can test live within just a couple of hours of work, which is super cool. And has been a great way to sort of seed some of the demand on the fintech side and tee up some really interesting use cases to present to our bank partners. So as a sort of a starting point here, we wanted to talk through, how it is that we at Synctera arrived on our approach to market and some of the interesting market observations that led us to build our business in the way that we have, and then use that as a way to highlight what Liftoff is and why we think it's a really interesting extension to the model that we have. So one of the first and most important observations we had when we started the business was that for fintechs, having a one-stop shop was a really, really appealing prospect. Historically, if you wanted to build any sort of fintech app, you had to go out and do deals with up to a dozen different stakeholder vendors. Not only did you have to find a bank partner, but you had to find a vendor for KYC, for card issuing and processing, for fraud, et cetera. And so one of our first principles was, let's take all of those capabilities and bring them under a single API and create a one-stop shop for banks. 2, we observed that for banks, getting into fintech banking or starting banking as a service was a really complex undertaking with a bunch of operational and compliance challenges. And in fact, some of our early customers told us that they were turning away fintech demand at a really high clip. And so one of the core principles underlying our approach has been to build a foundation of best-in-class bank operations and compliance tools to make it as easy and scalable as possible for our bank partners to manage fintechs over the life cycle of their relationship, with a big emphasis on visibility on the compliance side to make sure that it's as easy as possible for banks to stay on top of all compliance of their fintech customers. The third observation is that that core integrations in general are costly and slow, and something that our bank partners were really loath to undertake. And so we built our platform from the get-go to be core agnostic and not to touch a bank's core. And this allows for much more streamlined and rapid deployments for our bank partners. Fourth, we had an observation that banks and fintechs have different goals and capabilities. And this may sound obvious, but it's super important when you think about a market where thousands of fintechs are being created and funded every year that have different product needs and different risk profiles. And at the same time, across the ecosystem of banks, there are different product capabilities, different risk tolerances, and different goals. And so we built Synctera to be really a two-sided marketplace where we can play matchmaker and help banks find the right fintechs that match their goals, and help fintechs find banks that are going to be the right fit for the long term. And then finally, we heard pretty strong feedback and have experienced this firsthand ourselves as FinTech builders and in prior lives, that for both banks and fintechs, there's a strong preference to have a direct relationship. And so our initial go-to-market has really been focused on enabling our bank partners to resell our stack and take Synctera to market through direct relationships with their fintechs. And so all of these observations and details about our approach, we've received pretty positive feedback from both banks and fintech customers on all of these points. But over the last year or so, we've really come to learn that there are some ways that we can enhance the model, particularly as it relates to these last couple of points that we think can help both our banks and fintechs work together even more effectively. And that's what we want to talk about today. So specifically, what have we learned? Well, one, we've learned that fintechs place a really high value on speed and simplicity. And so as we think about how we structure our marketplace and the tools that we build, the more that we can enable simple solutions and fast solutions, the more likely we are to win business with fintechs in the market, both for ourselves and with our bank partners. Two, we've learned that the matchmaking approach that we've taken is really valuable, but that in order for it to be effective, there needs to be some degree of curation there. And specifically, if we take too much of a hands-off approach, it can become a bit messy. And so we've taken some steps to address that and figure out how to make it a more streamlined process for all stakeholders involved. The third learning that we took away is that direct relationships and control are super important. But if we have completely bespoke contracting, it can be pretty slow and expensive for all parties. And so the challenge that we took from these learnings was, how can we preserve all of the advantages of our model while responding to feedback on speed and ease of matching, speed and ease of due diligence, and contracting. And so with that, we came up with a new program that we call Liftoff, that really has the goal of being the fastest and easiest way for banks and fintechs to partner together. And Liftoff really looks remarkably similar to our original model in that we tried as hard as we could to preserve all of the stuff that was really resonating with the market. So still a one-stop shop for fintechs, still offering a single communication channel for managing a bank fintech relationship and approvals, et cetera. Still maintain the trust and verify model that we've put in place for compliance oversight. Still no core integration, still enabling a direct relationship between the bank and the fintech. And we're maintaining the same commercial terms meaning the underlying 50-50 partnership that we enter into with our bank partners. But we identified a couple ways that we could extend our model to address some of the learnings that I just outlined. And there are three changes specifically that we'll touch on today. One is we defined a specific eligibility criteria for fintechs to participate in Liftoff. And the goal here is really to make faster evaluation and diligence for our bank partners. Two, we standardize the contracting process in a way that's allowed us to move much, much faster with fintechs coming through the pipeline. And third, we've revised the matching process to be much more streamlined. And specifically, we negotiate program and pricing details with fintechs to get the best possible pricing that we can before we present offers to our banks, which has removed a lot of noise from the matchmaking process. And my colleague Chet will talk through that in more detail. So let's dive into each of those three, starting with who is eligible for Liftoff Standard. And I'm calling it Liftoff Standard here because as I'll talk about in a moment, we have two different flavors of the Liftoff program, Standard and Flex. And so Standard is what we're going to start with. And this is the program that is for what I would call plain vanilla deals. Specifically, what we've done is we've said, we worked with our early Liftoff bank partners to define a set of criteria which, if any fintech coming through the pipeline matches those criteria, it creates a really streamlined process for due diligence, evaluation, pricing, and contracting. And so those criteria are really around what programs are supported, what products are offered. We've put in place a number of limitations on high-risk categories. So this is not a program which is a fit for every fintech. It's really for right down the middle, pretty standard deals. We have strict requirements on operations and compliance and on policies. All the fintechs are required to adopt, for example, our standard KYC configuration, standard policies, et cetera. And we've put in place strict limits on velocity, return rates, et cetera, and other requirements around account balances, minimum funding, et cetera. And the idea is that for fintechs coming into the program, if they qualify and meet these criteria, excuse me, I'm dealing with a touch of COVID, so please excuse the hoarse voice. For any fintech coming in that meets the criteria, it becomes a really streamlined process for matching those fintechs to banks who have said upfront, these are the types of programs we're comfortable with. If you find deals that fit these criteria, we will bank them. And it makes for it reduces a lot of the overhead for bespoke due diligence because we pre-vet the deals to ensure that they fit these criteria. So let's look at the contracting process. And this is the biggest and most noticeable change relative to our original model. So to highlight that difference, let's start out by looking at the way we have originally been going to market and that we still offer through what we call our custom contracting process. And under this model, Synctera essentially resells our stack through the bank. So we do a foundational agreement with our bank partner, which we call the Synctera platform agreement. And this sets out the rev share and all the commercial terms between Synctera and our bank partners and gives our bank partners the right to resell the Synctera stack through to fintechs that we bring to the bank. And then on the other side of this, our bank partners sign bespoke agreements with fintechs to sponsor the fintech and provide all of our services, Synctera services on a resold basis. And so this is the fundamental model that we originally went to market with. So we learned a few things. One, while this model provided a huge amount of flexibility and control for our bank partners, it resulted in fairly protracted contracting between banks and fintechs. And the reason for this is because each of our bank partners, while we did provide and still do provide a standard MSA template to work off of, there's a lot of customization. Oftentimes, the legal teams of our bank partners are less familiar with the model. And as a result of this, we had a lot of tri-party calls. And these ended up being really drawn out discussions that were not just slow, but expensive. Think billable hours from outside counsel, et cetera. The result was a lot of lost deals where we were pretty far, we'd spend 2 months negotiating with a fintech, and ultimately they'd say, you know what, this is too painful, we're going to go in another direction. But also just general negative feedback from both our fintech and bank partners. So we took a stab at saying, how can we rework this in a way that preserves, as I mentioned, all of the things that we really value and our bank partners have really valued around our original model, but extended in a way that addresses some of the concerns. And this is where we came up with Liftoff for standard deals. And so here we flip things around. Instead of Synctera selling our stack to the banks for resale, we enter into an agreement with the bank where Synctera is effectively a super program manager on behalf of the bank. The paper that we sign with our bank partners is slightly different. It looks more like an MSA that a bank would sign with a fintech directly. And this contract includes all of the sort of key terms, including all of the financial terms. Second, we put in place you can think of this as an addendum or an exhibit under this program agreement, which we call a program authorization letter. And this is what defines the eligibility criteria for Liftoff Standard. All of those terms that I flashed on the screen earlier around the types of programs that are eligible, minimum funding requirements, et cetera. Synctera then, on the fintech side, signs a similar agreement with the fintechs and a similar program authorization letter with the fintech, which defines all of the details about what the fintech can do and all of the program economics. So the interesting thing here is that the model has been flipped. Synctera is contracting directly with the fintech, and the bank is getting the same economics, but does not have to directly negotiate those contracts. So a few benefits that we've seen from this. One is much faster contracting. We've taken our average contracting time down from multiple months down into a matter of weeks. We've seen deals that have been able to be signed in as little as a week, including the due diligence on behalf of our bank partner, which is pretty remarkable. And of course, the reason is because we do, as Chet will talk about in a bit, a huge amount of upfront work on behalf of our banks, ensuring that the fintechs that come through this program meet all of the criteria defined in the program. It's resulted in streamlined diligence, as I mentioned, lower legal fees all around because less customization in the contracts. And interestingly, the flow of revenue shifts slightly. Instead of the fintech paying the bank, who then rev shares Synctera, the fintech pays Synctera, who then rev shares the bank. And what this means is higher margin revenue for the bank. Same net economics, but it's sort of pure margin dollars that flow through to the bank instead of revenue with some rev share carved out for Synctera. The challenge, or this, I would say the limitation on this is that this only supports conforming deals. And of course, there are many interesting fintechs out there that don't fit in this nicely defined box that we've outlined. So after seeing some really great traction with this model and really positive response, both from our early bank partners and from fintechs, we took a look and said, okay, well, how could we take some of these benefits and extend to support any program? And we came up with a new model called Liftoff Flex, which you will see looks remarkably similar. So from a contracting standpoint, the fundamental agreement between Synctera and our bank and Synctera and the fintech are exactly the same as Liftoff Standard. But we put in place a program-specific program authorization letter that defines program-specific details on economics, on eligibility. We may carve out different treatment on KYC, for example. Maybe it's a business that is using a third-party provider for KYC or is taking some different process that would disqualify that fintech from Liftoff standard, but we can still put that deal through the same contract structure if we use a custom program authorization letter. And then on the fintech side, we put in place a sort of mirror image of that same program authorization letter, defining for the fintech what they can and can't do under the terms of this contract. So as an example, this could be a fintech who is doing a line of credit product, which isn't covered by Liftoff standard. We could still accommodate that fintech through Liftoff under this flex structure. So that is, in a nutshell, the contracting process and what's different. Let me turn it over to my colleague Chet to talk through matching and how we've refined the matching process to complement some of the changes we've made on eligibility and contracting.
Hey everybody, Chet here. Thanks for kicking it over to me, Shep. To give you a brief background on myself, been at Synctera for over a year now. Worn a bunch of different hats, but most recently taken on some of our BizOps functions as VP of BizOps, and will be your matching point of contact for a lot of the really exciting fintech opportunities we have coming down the pipeline. So as Shep mentioned, we've made adjustments to streamline processes across the entire spectrum of our fintech sales and onboarding process. And when it comes to matching, that was not left out. Especially with the ability to kind of standardize more of these straight down the middle deals that really are prioritizing that speed to market. So do you mind going to the next slide? Awesome. So previously in our prior matching process, we would bring fintechs to our bank partners, prior to any of the negotiations or contracting around economic terms. And I think what we learned from that is that typically fintechs have a price point in mind, or they have some sort of model in mind that they're looking for and want to speed through this. And so going back and forth between three different parties is slightly complex. And so with these new standard and Liftoff flex contracts, we have the ability to take a brunt of this negotiating work with the fintech. So you take your standard fintech coming down the sales pipeline, we're going to be nurturing them to collect all the information we can about what they want to launch, what type of risk qualifiers they have, what type of products they'll need, and most importantly, what are the economic terms that they feel comfortable with and the desired launch timing when they want to launch on a bank partner. We can take it up to the point until we need bank engagement, and for different deals that has a different point in time. But ultimately the idea is by the time it gets to you, all you need to do is evaluate the opportunity, the price point, and the launch timing to see if it's a proper fit for what you're looking for in a fintech partner. So these fintech opportunities will come down the pipeline to you in an email. Now for flex deals, these will come a little bit earlier in the sales journey for them, given it will require some additional scoping or diligence from your end, since it has some sort of risk variation. As Shep mentioned, these are things like prohibited categories or some sort of product that hasn't been standardized, right? Like lending or line of credit. But for standard deals, this will be at the very final stages of contract signature. So the contract has been sent. We have verbal confirmation from the fintech that they will be signing. And really, there's nothing else to confirm outside of just getting a thumbs up from a bank partner that they'll be able to launch on them. And in this email, you'll get all of the details that you need around a fintech, what their business is, what type of products they'll be taking from Synctera and the bank partner, any type of information around the founders and funding status, and any type of outside the normal information that would be required in a flex deal. So if they're operating in a cannabis or gambling category or something like that. And all the files that we've collected along the way and put together in a streamlined fashion will be added to share files so that everyone can have visibility into the due diligence that our risk and compliance team has put together, any type of pricing and projections that have been done by our deal desk team, and a pitch deck that's been provided by the FinTech. The idea is this email is going to give you everything you need to know to be able to turn around in 72 hours or so and give a thumbs up to us on whether or not you would accept them. And so the process of accepting is simple. Just reply back to the email with here's the deals that we want and here's the deals that we won't be taking. And for there, once the process has been closed out, so we'll be giving you a deadline in each email, we can go ahead and take a look and assign fintechs to the confirmed bank based on a variety of criteria. I think the most important things are if you're accepting a deal, will you be able to support all of the products that the fintech needs? And if not all of them, which ones will you not be able to support? What is the expected launch time frame that the fintech is looking for, and can you launch them in that expected time frame? Do you have experience in the industry that they're operating in? I know that some banks have a ton of experience and expertise in certain industries like crypto or cannabis. But most importantly, we want this to be as equitable as possible. So once we see that there's multiple banks interested in a specific deal, we're going to be trying to slot those in to balance the playing field essentially, and make sure that everyone's seeing as many opportunities as we can hand out. And the idea isn't to add in unlimited banks. We want to be able to find that right supply-demand balance so that we don't have too much fintech demand and not enough launch slots, and we don't have too many launch slots and not enough fintech demand. We want to be able to have that perfect balance of launch slots and fintechs looking to launch. So that will all be done via email on the matching threads. I do think that replying to the emails is important. I think everyone has certain conversations with various people internally, but if we can get that in the email thread and in writing, that would be the best case scenario. But once that's been done, sorry, go ahead, Mike.
Sorry, Chet, we do have a question
Yep.
related to, and the question is, would we be able to identify our screening criteria for proposed fintechs? And what are some of those problem elements that might be involved in that?
Screening criteria for proposed fintechs. What are the problem elements? So I'm going to try and understand the question. I don't know if we can, is there a way to go back and forth in the webinar, Mike? Like, how do I ask a question back? For the proposed fintechs, is that when you're talking about the proposed fintechs in the email, or proposed fintechs that have qualified for Liftoff or Liftoff Standard or Liftoff Flex? Eric?
So what, general criteria.
Yes. Okay, cool. So I think Shep covered this a little bit. I don't know if you want to jump in, Shep. I can list them off, but
Yeah, no, I can take a stab at this, and then Eric, you can let us know if this addresses your question. Our goal really is to help banks match with as many in the right type of fintechs that match their goals as we can, and for fintechs, help them find a bank that's willing to support their use case as quickly as possible. And so our criteria depends really on what the program is that we're talking about. For Liftoff Standard, we've defined a really pretty tightly and narrowly defined set of criteria, which is explicit. And I can actually flash back to the previous slide where I put that on the screen. It's really around what type of program is the fintech offering. Is we can support only through Standard, we're only doing consumer and business deposit programs. From a product standpoint, it has to fall in a list of specific products which are offered through Liftoff Standard. We have limitations on the types of business, so no MSBs. We have a long list of prohibited categories that the fintech can't fall within. We have a pretty detailed set of operations and compliance requirements, which we can share offline, the full set that falls into that set of criteria. And the list goes on. There needs to be minimum funding. There need to be certain balances maintained for reserve and for operational purposes. We put limits on velocity, et cetera. And so the idea with these criteria on Liftoff standard is to be very buttoned up and tight so that any deal that comes through on Liftoff standard should be a default yes for any participating bank. It should, by definition, we've sort of agreed up front, any deal that comes through that fits in this box, we want to do it. That being said, we know that there are, and in fact, some of the most interesting fintechs won't fit in this box. And that's why we have Liftoff Flex and our original custom model as well. And so the best way that we can work together is really to understand the unique goals and restrictions and requirements that each of our banks has, so that we can evaluate deals coming through and try to bring you deals that best meet your criteria. We've talked a little bit about, actually quite a bit today, about cannabis and crypto, because those are edge cases that are actually not standard. Most banks that we work with will not bank crypto companies or crypto related businesses, nor will they bank cannabis related businesses. But we have some banks that we work with who've gone really deep on the regulatory side and building out the controls and processes to support those use cases and actively want those types of businesses. And so by really understanding your goals, both from a capacity standpoint and from a eligibility standpoint, we can then funnel the right deals to you that meet your specific criteria. I don't know, Eric, if that answers the question.
He has replied, thanks. Okay,
awesome.
We do have another question related to contracting. With the change in architecture of the contract, now contracting with Synctera as opposed to directly with the fintech, how has this changed the classification of the deposits, i.e. brokered?
Interesting. Yeah, it's a really good question. We have a white paper on this that I think I'd be happy to share afterwards with anybody who's interested. This is something that I think it's important for each of our bank partners to discuss with their own legal teams. But our view is that this should not result in any difference in treatment from a broker deposit standpoint, unless we have a fintech which has deposits across multiple banking partners. And even in that case, our belief is that based on feedback from our own regulatory legal team and interactions with the regulators at the FDIC, we believe that there's not an issue from a broker deposit standpoint. But this is not my area of particular expertise. So let us share with you the white paper that we have on broker deposit treatment, and then we can have schedule a follow-up if helpful with our risk and compliance team to talk through some of those details.
Great, thanks. That's all the questions at the moment.
Awesome. Thanks, Mike. Sorry, can we go ahead and go back? I just want to close this out to make sure everyone's super aligned. So as I mentioned in the FinTech Bank assignment, you're going to get an email. It's going to have all the opportunities in it. We want to be as transparent as possible and make sure that everyone has the opportunity to see every deal. The only ones that may not be included in this is deals that have come from a previous existing relationship with a specific bank prior to engaging with Synctera. I think those are very small edge cases. Majority of deals will all be included in this email, specified out by the type of deal that they are, whether it's standard, flex, or custom, and you all have the opportunity to reply in the time frame. So assuming that a fintech goes ahead and gets a thumbs up, we can assign them to the bank. You'll get a congrats email from me, which says, hey, you have these fintechs that you'll be launching on this time frame. Fintech can go ahead and begin the onboarding process. Now, obviously, the onboarding process is a ton of different things. It's building to the APIs. It's doing a ton of just building, essentially. But I think one of the big pieces I want to call out here is they're going to be uploading the additional due diligence items. What we're going to be looking for is to make sure that, one, they're meeting all the criteria that we've specified in the Liftoff framework. So Shep just kind of went through the list, but there's a ton of different requirements that they need to meet from a funding perspective, from an insurance perspective, from a policies and procedures perspective, that we'll need to go ahead and gather during their onboarding process, because before they ever go live, there's going to be a final approval. Synctera will collect all of this, we'll review all of this and give our thumbs up. But at the end of the day, while you've accepted a deal during the assignment phase, understanding that we're going to make the assumption that a fintech has filled this all out, you're still going to have that pre-launch approval. So Synctera will never launch a fintech onto your bank without ever giving you that final sign off. And so we'll make sure that all the due diligence items, all of the additional information and context that the Synctera team has gathered on the way during onboarding is given to you in that final sign off before a fintech goes ahead and launches into production.
We do have a question, Chet.
Awesome. I love questions.
Perfect. What is the relationship between Liftoff and ground control? Will all of the fintechs coming through Liftoff be using ground control?
Shep, you want to take this one?
Sure. That's a really great question. And I love it that folks on the call are familiar with some of these other programs. We didn't talk about ground control today, but I'll just give for those who may not be familiar with it, I'll give a really quick summary as to what it is. Ground control is a banking and compliance operations offering that we manage within Synctera and offer for free to fintechs on our platform. But you can think about this as Synctera being almost an outsourced service provider to the fintech to manage their all of their payment and banking ops issues and compliance queue on behalf of the fintech. We offer it to the fintechs for free for the first 6 months. And the idea here is sort of operations training wheels for some of these earlier fintechs who may be new to the space to get their feet under them before standing up their own operations and compliance program. It's been received really well on the fintech side and also among our bank partners because we offer this, it ensures a high level of compliance oversight and process in place for even the smallest fintechs coming in through the program. We offer it for free to all fintechs, and I think our attach rate at this point is close to 100%. It's been really well received by fintechs, and any bank is welcome to require that fintechs that they accept use ground control to get started on the platform. At the end of 6 months, ideally fintechs have built their own in-house capabilities or have contracted with their own BPO to manage their operations and compliance on an ongoing basis. But we have the ability to extend ground control on a paid basis for fintechs as needed if they require it. So I think our attach rate is probably close to 100% at this point. But it's not a strict requirement unless a particular bank wants to require that any fintechs it works with use ground control.
We do have a follow-up as well. Also, are Liftoff and T-10 the same thing?
Great question.
Yeah.
And this is particularly confusing for many of our partners. This is a bit of an own goal on our side, but we have a subsidiary, a wholly owned subsidiary through which we manage the Liftoff program, which has a name T-10, which is also the name of our developer platform, which I know can cause a lot of confusion. But to be very clear, Liftoff and T-10 are two different things. T-10 is a developer environment. Think of it like a developer sandbox, except that it is a live environment where fintechs can actually build and test their app end to end with real money. And it is also a set of guided experiences to help the fintech build, not only from a technical standpoint, but from a risk and compliance and launch readiness standpoint. So the fintechs that come in and start building have a really curated, guided approach to get from writing their first lines of code to having a fully tested, certified fintech app with all of the compliance and policy work wrapped around it, which is ready for launch. That's a tool really to help FinTech builders build. Liftoff is the contractual structure and program to help fintechs launch in the most streamlined way. And if they fall into a particular predefined set of criteria, then that's a Liftoff standard deal and is the fastest and easiest way for them to get live. But also if they have some unique aspect of their program, which disqualifies them from Liftoff standard, that's when they would fall into the Liftoff flex contracting model that we talked about earlier. But yeah, just at a very, very high level, T-10 is the set of developer tools to help our fintechs build, and Liftoff is the program to help them get matched and sign a contract as quickly as possible.
Great. No further questions at the moment.
Great. Chet, did you have anything else on this slide, or should we keep going?
Cool. Yeah, no, I think just to summarize, the idea here is to make sure that it is as fast and low lift as possible for all of our bank partners when we get these, vanilla deals coming down the pipeline who want to go the Liftoff program. So if you do have any questions, please feel free to reach out to myself or Mike. I think the most important things are look out for the email that comes with all the deals. Check them out, reply if you have any that you're interested in. We can begin working with you to make sure that we can get you more opportunities launching with your bank. Thanks.
So early results. We piloted the Liftoff program starting in January this year, right around the end of last year, and found right out of the gate really strong response with our fintech partners as well as our early bank partners on the program. And pretty quickly, this has become the predominant program that we have for matching banks and fintechs. I think the vast majority of deals coming through the pipeline now are Liftoff type deals, because both our bank partners who are in the program as well as the fintechs themselves are opting into this model, which has been really validating. We've seen some metrics that support that sort of highlight the benefits. So the contracting time, as I mentioned, has come down from multiple months under our original model to just a matter of weeks with the new model. The diligence and matching process has come down from months to days or weeks. And as a result of this, we've seen a really strong uptick in velocity of deals coming through, deals getting matched, and fintechs moving from the evaluation phase into the building and launching phase, which has been really exciting. So we've been really pleased with the program so far, and more it's starting to look like the standard option rather than an exception case. So we have a bunch of bank partners who are already working with us on Liftoff. We have many others who have not yet signed up for the program. And we would love for as many of our bank partners or prospective bank partners as possible to be a part of this so that we can start sending deals your way. And so in terms of next steps, the first thing is, if you're interested in learning more, doing a deeper dive, or have any follow-up questions, Mike Morel is our MC today, is your man. And so I would love to get you connected with him to have a follow-up conversation on how to move it forward. The real, the sort of fundamental thing that needs to get in place, which looks different from our standard original model, is putting in place the Liftoff program sponsor agreement, which has been pretty lightweight for anyone who's done our, already has our original agreement in place. It should be pretty straightforward to get the Liftoff agreement signed, and we've had these move pretty quickly with the bank partners that we're working with today. And then the final piece is to start accepting deals and start working with Chet and team through the matching process to really articulate and come to a clear alignment on how many and what type of deals you're interested in, so that we can be as thoughtful as possible in bringing you deals that match your goals. And you'll see all deals no matter what. We want to make sure that you have visibility into the full breadth of deals that are coming into the pipeline. But we also want to be a really active partner in helping steer deals in your direction that best meet your particular goals from a program type standpoint, et cetera. With that, let's open it up to questions.
So we have about just under 10 minutes left. If there are any questions, please feel free to put them in the Q&A tab, or feel free as well in the chat, and we will address those as they come up. Oh, we have one currently. Longevity is a key to a profitable partnership. What keeps the fintech at the partner bank? What keeps them from leaving as they grow for better pricing?
It's a really good question. So longevity has a couple of dimensions. One is will this fintech ultimately become a successful fintech or not? And then I think the other dimension of the question is how do we keep them on our, keep a matched fintech working with us and not leaving to go elsewhere? I'll take those in turn. The way that we think about this business is really through a sort of probabilistic lens versus a deterministic lens. We have a bunch of, another way to phrase that is we sort of look at this as through a similar lens that a VC would look at funding companies. There are a huge number of really interesting fintechs getting created every year. And it's difficult upfront to determine which of those are going to be the next Square and which are not. And so across any bank's portfolio of fintechs, we would naturally expect to see a distribution where some of those fintechs end up performing really well, and others are kind of in the middle, and a few that maybe end up just paying their minimums and go for a couple of years and never really find breakout success. The key to building a large and profitable portfolio overall, therefore, is to make sure that you're taking on enough sort of bites at the apple to make sure that you're catching some of those opportunities that turn out to be the next Squares. And so our goal is to really understand what are the risks that you're comfortable with, what are the risks that you're not comfortable with, and then help you find the right volume of deals that are most likely to give you a high number of sort of winners in the pool of deals that we bring to you. But the reality is some of fintechs will ultimately not be successful, and that's okay. We'll work together to make sure that we manage them through the life cycle in a really responsible way, and at the very least that we're collecting minimums over the course of the relationship so that you make some money off of them. I think the second part of your question is what happens if the fintech becomes really successful? Are they going to ask for better pricing? Did I get that right, Mike?
Yes, exactly. Question was, longevity is a key. What keeps the fintech at the partner bank? What keeps them from leaving as they grow for better pricing? Exactly.
So I think that this part of this has to do with the relationship that we enable between the fintech and the bank. This is not transactional. It's a pretty deep relationship, and our whole platform is really built around maintaining a direct relationship between the fintech and the bank. I think, best case scenario, the fintech is wildly successful and becomes really big, and we need to, and they come back and say, we want better pricing. I think that's something which, is likely to happen among any fintech as they grow and achieve scale. But as it's not a costless proposition for a fintech to switch banks. In fact, it's a pretty big pain. And so what we want to make sure is that we can be a good partner and advisor to you to help keep that fintech with you and help them achieve their goals, but also ensure that you're still, have a profitable relationship there. So will really successful fintech deals be repriced at renewal? It's totally possible. But we're not going to, we want to make sure that we're helping fintechs get all of the capabilities that they need in order to be successful and run their business. But if there's no benefit to the fintech in leaving you as the sponsor bank. In fact, there's a cost associated with that. So while they may come back and if they achieve a certain scale and look to reprice the deal, if you have the fintech out of the gate, you're in sort of pole position to keep that deal over its lifetime.
So we do have several questions that have come on, and we're about 3 minutes to the top of the hour. And so we can, we'll tackle probably one more before we end. Question is, what happens to customer relationships, deposits, or loans for fintechs that fail or decide to change path?
So if a fintech fails, then we have a sort of standard playbook of returning, the funds need to be returned to the deposit holder, to the end user consumer, and we can process that through an ACH back to the original funding source or through a check. But ultimately, those sort of accounts would be unwound.
Okay, and we can get another one in. Why would a new partner bank go through the Liftoff process instead of your original longer process? Is there more risk with Liftoff?
I think the reason to do Liftoff versus the original model is because it preserves all of the benefits of the original model, but with much faster velocity of deals and the ability to get more fintechs on your bank that meet your criteria with lower cost. And ultimately, that's the name of the game, is how do you reduce the barriers to onboarding fintechs, reduce the cost of managing them over the life cycle, and maximize the ability to earn revenue from them. And we think that Liftoff, and what we've seen is that it's been really attractive for that. From a risk standpoint, the differences in terms of the allocation of risk between the parties, Synctera ultimately is on the hook for compliance of all fintechs that are operating through the Liftoff program. And you have sort of contractual recourse to Synctera to ensure performance of fintechs under the program. We in turn then have contractual recourse against the downstream fintechs. So happy to take that one offline and go deeper on it if there are questions. But given the profile of many of the fintechs joining our platform, which tend to be pretty early in their life, we tend to skew towards startups. We believe we actually provide a liability shield to a certain extent to the banks because we're signing up to ensure their compliance with all of the programs.
Excellent. So as we are approaching the top of the hour, we want to thank all of the attendees who participated. The questions and discussions was fantastic. Also want to thank Shep Smith and Chet Montefering for being on our panel today and for their great presentation. So thank you both for joining us. To the attendees, we'll be following up and making sure everyone has all the contact information, mine as well as Chet's, for any questions moving forward. And then we'll also make sure to get out that white paper and any accompanying documentation. So we look forward to continuing this discussion in the future. Thank you, everyone.
Thanks so much.
Thank you.